All right, very good morning. It's Friday the 22nd of June, coming up for a big anniversary. 2 years almost since our breakup with Europe. So you can celebrate that over the weekend, enjoy the summer sun. But in terms of what we're going to cover in this briefing this morning, we're going to have a little bit of a recap about the Bank of England and what happened yesterday and what does the future hold now for the prospects of the pound. We're also going to have a look at OPEC. Obviously, we've had this OPEC seminar happening for the last 2 days, and we're going to have the OPEC official meeting today, where they look to formalise what could be a tentative agreement made last night. And then we're going to have a look at a few other points of note for the calendar ahead, and a bit of a recap of some PMI data that's come out this morning. So that's what's on the agenda. Starting off with the broader market context this morning, you can see here on the currency charts, on the top left, you got Eurodollar and cable. Let's start with Eurodollar first, because we have seen some decent upside as Europe has come into the market. Now, I've got this on a 90-minute candlestick. What I'm looking at is a bit of a push higher in the euro, which has broken that kind of Asia Pac high that we printed on the 19th, and consequently R1 just helping exacerbate some of that initial price movement up to around the 117.50 on the intraday high. Now, it did coincide with some of the PMI data. I don't necessarily think it's the PMI data that's really forcing it higher, but it certainly probably helped as a catalyst at a key technical point, layering in then the R1 as well, and we get a bit of an extension of the move in the euro. With the service and manufacturing numbers in France on the PMI side, the service number was a beat, the manufacturing was a miss. In terms of Germany, the service number was a beat, the manufacturing was a miss. So overall, the composite figures on both countries were a little touch higher than expected, but nothing phenomenal. But certainly, I think the technical move here has probably helped some of the price action. I was just looking on a longer time frame, and maybe puts in a bit more perspective. Here is the euro-dollar pair, looking on a slightly larger time frame, so encapsulating some of May and June. And obviously this breach of the technical point that we've just seen around the timings of the PMIs this morning, helping us get above that 1724, and then just coming up now, that first kind of area of resistance being then the kind of early June low we printed on the 5th, as we continue to just pull back some of the reversal from the ECB-inspired sell-off that we had. Probably that 1745.50 area as a point of potential resistance in the euro, and hence we've had a bit of a hiatus in that move higher, at least for the time being. But certainly a level to watch if that upside continues in the pair. Quick look and review of the pound then, because obviously, again, this is a longer time frame. This is a 90-minute candlesticks I'm looking at. So, of course, we can look at what's happened with the Bank of England yesterday. Surprise, actually, 7-2 was the consensus. We obviously got Andy Haldane, chief economist of the Bank of England, kind of bucking the trend, and he went with the Uber hawks, if you like, McCafferty and Saunders, pushing, as they've always done, for an immediate rate hike to 0.75%. Some of the commentary as well was fairly surprising, and certainly has tipped those odds, which were tracking at about 40% for an August rate hike, have bumped certainly over 50% now. So August is for sure back on the table. One of the things I thought was quite interesting now, I was reading an article in the FT, and they quote a chap, they're talking about the hawkish Bank of England, the pound's best friend. And it's one of the analysts that comments in the article, a chap called Stephen Gallo, who's the head of FX strategy at a big Canadian firm, BMO. And I know Steve quite well, because when I was a junior on a desk, when I very first started back in 2006, he was actually the first guy I started working with at the time. And he puts out quite an interesting view in that he's saying, and he does have some history of precedents to support his argument, he questions at the Bank of England, are they jawboning the currency? Now, this terminology, jawboning, you tend to hear from time to time. What it refers to is the central bank purposefully commenting in such a fashion in order to kind of manipulate the price in that way. So in this sense, what he's saying is he thought the minutes looked quite doctored up to the point to shore up sterling, provide a bit of support to interest rates, i.e. start bumping up the interest rate expectation in the nearer term for a rate hike in August, and subsequently the pound's going to start rallying. Now, why would he make such a comment? Well, if you go back to basically the summer of last year, the Bank of England, in the wake of their June meeting, they delivered a 5-3 vote at the time, despite doubts about economic outlook, because obviously there are some quite notable doubts about our economic outlook, not just economically, but obviously politically with this uncertainty on Brexit. But at the time of last year, pretty much the same point in the calendar year, sterling was trading it down at 126 and inflation was overshooting, and within 3 months the pound was at 135. By the end of 2017, inflation had begun to fall. So what I'm suggesting here is they weren't in a position to hike interest rates at the time because it was inflation only that was the real threat. The rest of the economy was quite weak. So doing an interest rate hike actually could damage the economy but contain inflation. A way to counter that is you could threaten to hike, expectations in the market could change, and you could influence the pound to come back higher to mitigate inflation in the long run. I know it's a little bit of a domino effect here, but is that what's going on here? Has Andy Haldane taken a bit of a hit for the team in order to just quell some of the sell-off that we were seeing in cable? Because when you go back to the cable chart, I mean, it's a real strong sell-off that we saw since we hit that kind of double top that really defined 2018 and the kind of beginning of the year to the April high, got right away up through 144 handle, and we've come tanking lower over the course of the last month or so. I mean, the peak that we printed was back on, looking about 17th of April. The last 7-8 weeks, it's just been under an assault in the pound. Certainly there's been economic data to validate that move. Growth is slowing, inflation is dropping, political uncertainty, you could argue, is growing. But here we are. If the pound started to go lower, let's say, forget the move that's happened in the last few days and yesterday. If the pound started going down to 130, that 135 is such a big level as well on the longer term chart post the referendum. If that breaches and let's say we got below a 130 down to this area, well then that's going to be, again, starts to become problematic for potential reignition of those inflation concerns, which they might have thought they had under control. So is this a little bit of the plunge protection team coming in to avert any further sterling depreciation in order to mitigate any return of inflation? I think, I don't want to speculate too much, but just quite an interesting point that I thought Steve put out in the FT this morning. Otherwise, let's look back at the pound and where we are at the moment. We've had a bit of a lift. The dollar's on the back foot this morning. I mean, obviously you've seen a bit of that euro strength, which has probably just weighed on the Dixie a little bit, given the euro comprises of the bulk of that basket. So the Dixie's down about 1/3%. Consequently, euro dollar's just edged up. If you think about sterling as well, from a fundamental perspective of the cable pair. So if you look at the pound fundamentals, you've kind of got, at least for the time being, this whole mess around the meaningful vote has now passed. We've gone through this ping-pong phase of the lower and upper house. Fine, the government's won out in the end, we move on. Obviously, we've got big EU summit coming up in the coming days. That could be obviously interesting for Brexit. But at this point, that kind of worst case scenario, if it was a small tail risk, has been averted in the near term. Not only that, you've now got layered in a slightly more hawkish Bank of England. So the fundamentals, you could argue, have changed a little bit into the more hawkish side that supports that upside move. Then on the same time, the trade war situation seems to have just certainly come off the boil a lot comparative to the intensity of which the market was focusing on back on Monday and Tuesday. So does that then pull back that quality, flight to quality bid that we saw at the beginning of the week in the dollar? So you're getting a bit of a change in the dynamic in the pair. Fundamentally, some dollar weakness possibly, with then on the flip side, some sterling strength, creating the divergence in those fundamentals and helping support the move higher. Technically, looking at the pound, where we are, we've kind of got that previous high, looking at the SEP futures contract here on the 15th. That pretty much lining up with the R1 today. So that level at the 133.54, the R1 printing up at the 58 mark. That's probably there also. Likewise with the euro, with a fairly significant resistance point on the upside to look out for. Otherwise, elsewhere, equity markets, we are relatively stable this morning, if not off to a positive start. The DAX, though, held thus far by the pivot level. As you can see, we've kind of blipped, had a test. That was kind of the support point as well that we saw through really the bulk of the European session before the break came shortly after the cash equity open in the US yesterday. On the recovery, though, we're just finding a bit of resistance there, so worth keeping an eye. If we can get our heads above there and break above, then maybe we get a bit of a reversal from this kind of the sell-off yesterday. Obviously, a big topic in the German equity market was about Daimler and weakness in the automotive sector on the impact of the trade wars and so on. As a consequence of some equity strength, albeit moderate, fixed income futures are lower. Bund's down 25 ticks. The 10-year is sub-pivot down 5 ticks, as you can see in the bottom right. One thing I just wanted to have a quick look at was the Dow. Now, the Dow actually, if I flip over my daily chart, a few people are starting to look at the 200 DMA in the Dow. Why are they doing that? Well, I think it's, if I read the stats correctly, we've had 8 consecutive down days in the Dow. And so this starts to bring us back into close proximity to something at which the market was looking at quite intensely a few weeks ago. That's the 200 DMA, defined here by the blue line on the chart. So just layering in that previous low that we printed back on the 29th. So I'm looking at a daily continuation chart here. You can see there's a really big level of support that could definitely be interesting around this kind of area here. That being then the previous low that's really held up the price action. You'd have to go all the way back to the beginning of May, last time we were trading lower than that 227 in the Dow, and that's pretty much bang on where the 200 DMA resides. Now the 200 DMA, for those who haven't looked at this chart on a much bigger perspective, so this draws into 2 phases. This was the blip and recovery we had on the initial reaction to the EU referendum in the summer of 2016. This, of course, is Trump surprisingly winning the US election and then the rally that ensued thereafter. But as you can see, and even when we had the February big dip, we got close to it again. We then, when we had the tech kind of sell-off and everyone was panicking about the overvalued nature of that sector, we still managed to hold. Did briefly break through it, but never really have sustained a break of that level. And here we are coming back in close proximity to it. So it is a really big level that I'm sure as it draws closer, it almost becomes self-fulfilling, that people are drawn more and more to looking at it, and then it becomes all the more important. Such are these kind of shared collective behavioral view of markets on these big levels. So worth keeping an eye on that. It's still, I mean, it's a way off. Don't get me wrong. I mean, we got to get down to 227. We're trading at 24,551. You got to see a good 250 point sell-off to get down to that level. So on the probabilities here, I would say that's unlikely to happen in case of the Dow. But certainly as we go through the coming weeks, if trade wars were to escalate again, certainly, then it could be something that's brought back on the agenda for the longer term. Looking here on a 60-minute on the S&P, I think you've just got to look at this in a bit of a step back and look a bit objectively. Let's look at the range, clear off a couple of these lines. So the weekly range is defined here by this kind of low that we printed on the 19th, then the high that we printed actually in yesterday's session. And so we're bang on mid-range at the moment from what has defined really the week's price activity. The pivot level, that previous low on the 18th as well. But yeah, not sure how comfortable about committing either direction here. I guess one of the things obviously to look out for, I saw a couple of tweets this morning talking about the EU's retaliatory tariffs on a number of US goods actually comes into physical force today. Although that's priced in, just remember from a political perspective, now that actually it's actually happening, does Trump come out and start firing some tweets out of an aggressive nature on that subject? Something that could be a risk factor. All right, one other thing, just rounding off on the equity space. We did talk about this at the beginning of the week, but if you remember, I did say that it was going to be a non-event. And it's because, absolutely no surprise, as we were anticipating, all of the banks passed through the stress tests in the first phase from the Fed with relative ease. There was a couple who were quite close to the line. Actually was Goldman Sachs and I think it was Morgan Stanley. But Goldman's have already come out and issued a statement talking about, well, actually, these numbers don't truly represent the firm's actual capital return capacity, etc., etc. The point being, though, that 35 of the country's biggest lenders in the US have survived the kind of most stringent stress test on their balance sheet if there was an economic kind of catastrophe, i.e. even to the worst depths than the financial crisis. So all in all, I would say you might see these types of stories run. Are the market going to really react to this? I think no. This is already completely as to be expected and is shown and fitted with the improvements that we've seen with these capital buffers for some time. Okay, final big thing that we're looking out for today then, just to get you fully up to speed, is of course this. And we've got the OPEC meeting. So as is always the case, going into the OPEC meeting, we already know the result because they've been discussing for a number of days in Vienna of what exactly they're going to do. I'm going to caveat this with a warning, again, that just because they appear to have had a tentative agreement, that doesn't mean that's exactly what's going to materialise in several hours' time. Could be a whole different ballgame. Hence or the nature of OPEC. But as we stand at the moment, OPEC and its allies have reached a preliminary agreement in the face of strong opposition from Iran to boost production by a theoretical 1 million barrels a day. So important word here is it's theoretical, because actually the final deal, if it does get formalized, means that in actuality not every country can respond to this request to improve output. The Saudi energy minister himself said that 1 million barrels a day is nominal. The actual impact will be less, and what actually is delivered to the market is going to be smaller. The actual numbers then, the real production increase would be around 600 barrels a day, according to a delegate familiar with the internal calculations that have been made. So if you remember, countries like Venezuela are absolutely not in a position to boost output, given what's been happening domestically and politically in their country. And Mexico also seen as unlikely to be able to pump any more from the non-OPEC side. The caveat then comes because obviously the big thing was about, can we get Iran on board? Here he is, the chap in the middle, that's the Iranian oil minister. And basically he walked out in the meetings with all these top-level officials yesterday. So there still is a risk that this whole thing could just break down. But the point being, though, is that I guess if we look at oil, I haven't even really had a chance to look at the chart in a broader context, but if you look at oil, and this is the last day, we've been rallying to the upside, because the point being then is that this talk of a 1.5 million, I've just got to thank Charlie for putting on some lovely pink lines on my chart. I appreciate that. Thank you, Charlie. But the point here is that the 1.5 million, which the market was kind of prepped for, from what the Saudis and the Russians were communicating, Trump was obviously pushing for his pushing of gasoline prices lower ahead of July 4th at the pump, and he was calling for 1 million. But actuality, what's going to happen is way smaller than that, only about probably a third of actual increase. So hence the reason the market's probably moved a little higher, a little bit disappointed. But as I said, I would be absolutely mindful of increased volatility today, and that this deal this tentative agreement could absolutely break down. And if that is the case, maybe we get another shot in the arm on the upside, and then it comes down to Saudi and Russia, which are actually meeting tomorrow on Saturday. maybe then we get down to the real nitty-gritty of it, when those two kind of superpowers in the crude market get together, and what do they decide collectively? On the upside here, just looking on a daily chart, obviously we found a bit of resistance around this 66 kind of 50 price point, which was the highs back in March, high also in the beginning of the year, late January. Force above that, you've got the $67 handle obviously, and then the big move that we've had would be a correction back to 70-72 longer run. Obviously these are much broader targets for the medium term rather than anything immediate, but certainly we could break that 60-65 and target a 67 today under the right news coming out on this OPEC situation. As per usual then, you've got to be planning about schedules. When exactly are these guys going to be speaking? And so what needs to happen then is that with OPEC, actually just 1 second. Charlie, love it, mate. With the OPEC agreement, you've got the tentative program. Here it is. You've got the opening session, where this is Vienna time, so actually it's an hour ahead, so you need to just +1. But the actual press conference isn't coming until later in that respect. So if you look here, you've got Friday today. This is the schedule for the OPEC, non-OPEC meeting. So really they should be outlining something at around, officially, from the Secretary General, who's kind of the Lord and Executioner who delivers the end verdict. That'll be at 2 o'clock our time. But as I've said before, it can often come early, it can often be delayed. You're just going to have your wits about you and maybe just keep this as a bit of a crib sheet to add to the timings of your day ahead. All right, final thing then, just looking at the calendar, what else is there coming up? Well, you've got the Eurozone PMIs due for release shortly, but this is basically the net summary of that, of the PMIs we've already seen, so not looking for much of an impact out of that. Probably going to follow suit, with the slight nuance between performance being quite solid in services, weaker in manufacturing. Going further forward, if you're in the live trading room and you like the CAD, the loonie volatility, you're certainly probably going to see some of that when the inflation numbers come out for Canada. That'll be at 130, but from a US economic data point of view, it is fairly light. You do get the respective PMI flash readings for June coming out at 245, but otherwise it's pretty quiet, and then that OPEC meeting starts really kicking off a bit later on, early part of the afternoon. Finally, just to end things on the week on a high note, to run you into the weekend, I did see this. So I'm an analyst turned weatherman. You've got a heat wave on the way. Temperatures set to hit 30 degrees. And it's going to be sizzling this weekend. So have a good one. Enjoy the football. Break out the Pims. And I'll see you on Monday. Thank you very much.